Well, Fed speak takes on an extra importance in the weeks to come. We are monitoring some this morning as well. Richmond Fed President Thomas Barkin saying he's, quote, comfortable doing more if incoming data doesn't show weakening demand for goods and services. Fed Governor Chris Waller also making headlines on credit conditions and the state of banking. Waller says during remarks in Norway that he wouldn't want to alter policy because of a few banks, adding, quote, while lending conditions imposed by banks have tightened since March, the changes so far are in line with what banks have been doing since the Fed began raising interest rates more than a year ago. So joining us now, we've got José Torres, who's the Interactive Brokers senior economist. All right, Fed speak galore, Jose. What do you extrapolate from what we've heard just this week?
Thanks for having me, Brad. Well, goods and commodities have been experiencing deflation, and that's contributed to lower year-over-year readings on CPI, but services remain red hot. Core CPI came in above 5%. We added over 330,000 jobs in the month of May. Wage gains continue strong, and services make up most of the economy. So if services continue to come in hot, then further monetary policy restraint is going to be needed by the Fed. In fact, most participants expect 2 more rate hikes this year. Some even went as far as to say to go over 6%. And services are very tough to bring down. It's not like goods and commodities, very labor intensive. That's a long process. Also, on the commodity side, Russia's invasion of Ukraine occurred a little more than a year ago, and that really contributed to a lot higher gasoline prices. A lot of those base effects and why we're seeing lower year-over-year readings now is because of that differential. That's going to fade about late summer. Also, today's consumer sentiment number, a lot hotter than expected, big improvement. Whenever you have a risk-on rally on the Fed, that tends to loosen financial conditions. Things like oil prices go up, bond spreads tighten, and that in this cycle, like in July, like in January, leads to a new leg in inflationary pressure. So I think the messaging from the Fed going forward here is going to be very important.
And you mentioned a number of contributing factors here to the Fed's decision. As we look at especially the U.S. labor market, what needs to happen there, do you think, before you think the Fed will be satisfied?
Unfortunately, you're going to have to see the unemployment rate go up. It's already gone up 30 basis points from the low. Historically speaking, every time you had a 50 basis point increase, you've gone into recession. This is a little different because we're coming off a really low level. But I think you'd have to see the unemployment rate probably 4.5 to 5 to get inflation maybe at core PCE, maybe at 2.9, 2.8, which would then be a level where the Fed would still probably have to remain at whatever rate they're at and wait for that rate to come into the low 2s and then maybe start cutting.
Jose, what's the most important piece of data that you're going to be watching over the next month? Is it going to be sort of the traditional PCE, or is there something that you think isn't getting enough attention than it should be?
Well, I'm going to be looking at the PCE. I'm also going to be looking at jobs. I'm going to be looking at CPI. Also going to be looking at what's going on with the banking sector, right? You guys were talking about this earlier and how lending is progressing. In lending, you had an initial credit crunch around April following the regional bank debacle. But since lending and banking has been operating under pretty normal conditions, but there's still about 30 banks that are problematic. So I'm going to be watching those statistics to see how much more tightening does a potential crunch in lending give space for the Fed to not have to go as high as they want to.
If, like many bank executives have estimated, we hit a Q3 2023 recession, how much additional tightening do you think the Fed is going to believe that they need to do?
Well, Brad, I think that if we do hit recession in the second half of 2023, I think the Fed can probably stay at whatever rate they're at. By then, core PCE will probably be down to 3% because that'll cool a lot of the services inflation. And then in early of 2024, the Fed can probably start cutting pretty aggressively.
Jose, thanks a lot. Good to see you. José Torres is Interactive Brokers senior economist. Appreciate it.